Hello, this is Brian Resney, President of Resney Wealth Management, bringing you an important update about the economy and the investment markets. Well, we're in 2021. 2020 itself was actually quite a great year for our clients. I'm glad to say that my staff and myself worked hard all year. A lot of research, a lot of money spent, a lot of man hours looking at the economy, the investment markets, and I'm glad to say that our clients did quite well in 2020. Of course, 2021 is a whole new year. We're going to be making some portfolio adjustments again, as we always do throughout the year, but we've got a few more significant ones we're going to add in. We're going to try to add a little bit more value. We're going to be trimming some of our tech exposure. There's a few areas of the overall market that's a little frothy, to be brutally honest. Not everything, but maybe 2 to 3% of equities out there that are really kind of these crazy nosebleed areas that we're going to avoid. One of the things that I often try to educate every investor is simple. Things can go up for a long period of time before they come crashing down. And these would be bubbles. Not the equity market as a whole, but there are certain stocks. I'll give you a great example. There's a company called Tesla, the electric car company. This is a stock last year that went up over 600%. The stock trades at about 1,000, that's 1,000 PE ratio, price to earnings. To give you perspective, the S&P 500, which is a broad market index of about 500 leading companies, which Tesla is now part of, by the way, as of about 2 weeks ago, trades at about a 24 PE ratio. So 24 price to earnings ratio, so 24 years of profits to buy essentially the S&P 500, or 1,000. So when I see stocks like that, that tells me that you've got a lot of small investors that are just chasing investments just because they're going up, that have truly no idea what they're doing. Now you have to remember, I've been managing money for a long time, well over 30 years. I've seen bubbles form in other areas of investing, whether it was in real estate, the bond market, oil, gold, the stock market, what have you. The key is this: steady Eddie wins the race. So we're finding great values out there in the investment world, but we're going to avoid those areas that are truly overpriced and really are in bubble territory. And that's where discipline comes into play, strategy comes into play, a lot of research comes into play. I spend the majority of my time every day, and my staff really doing a lot of research, really the economy, the investment markets, where we need to be, where we want to be, areas we want to avoid. These are all important things to have happen within a portfolio structure, strategy, and of course the ultimate management of the assets itself. You can always chase something that has gone up a lot, but those people always ultimately get burned. One of the things that's popped up in the last few years is a lot of trading platforms, like Robinhood's one of those, where investors jump on these things and trade in and out of these different various investments throughout the day, throughout the week, what have you. And again, these people will get burned. I firmly remember 2020, when technology stocks, not all, but a small group of them, were trading at crazy valuations, 200-300 PE ratios, not even close to what Tesla's trading at 1,000. But if you looked at a lot of those stocks, they're out of business. They dropped 99% in value over the next couple years after 2000. So again, it might look real good, it might look kind of shiny for a while, but we're never going to buy anything that's grossly overvalued. We're not going to chase things that are overvalued because we understand what happens. And that's why clients hire our firm to manage their money properly. And as always, we see the economy this year actually doing quite well. We should probably grow GDP somewhere between 4 to 7% depending, but that would be very solid growth coming out of last year. We see the potential for the equity market to continue to expand. We see potential for inflation to come back a little bit, nothing crazy, but I think at least we're going to hit that 2.5% inflation target this year. And that could mean that interest rates will go up a little bit. Bond exposure, we are holding mainly floating rate type bonds in our portfolios for safety purposes. But again, keep within your risk profile. There's always an opportunity to make more money, but there's always opportunity for a little more volatility. One of the things that I would say when I look back at 2020 is staying true to research and strategy and not becoming emotional. Our staff did exactly what we needed to during the pandemic and the downpull of the equity market back at the end of March. We stayed the course. I'm glad to say our clients allowed us to do our job. We had a few clients that got a little bit nervous, but very few. But generally speaking, our clients benefited because we did what we needed to do within the portfolio management structure. With that said, we look at 2021 being an opportune year. We look at a potential growing and expanding economy at least the next 3 to 5 years coming out of this. I think there's great potential. But there's going to be some risks also. Expect a 10 to 12% pullback this year in the value of your portfolio. Every single year, we get about a 10 to 12% pullback in the overall equity markets, the bond market, gold, real estate, everything has volatility. So if you remember that that's going to happen and you expect it to happen, you won't be shocked. Now, it may not happen this year, but again, we're always going to look for some of that volatility. We've had a nice run up. I wouldn't be surprised if we have a little bit of a pullback, but sometime this year we're going to get some more volatility. But ultimately, over the next 3 to 5 years, I see the U.S. economy doing quite well. I see Europe, as I've talked before, not a great place to be invested because of socialism and really the way it's done. Of course, Brexit is officially happened. It only took them 4.5 years, by the way, after it was originally voted on for basically Britain to leave the EU. There'll be other countries in the coming years, in our opinion, that will leave also. But not really great places to invest because of the amount of massive debt and the lack of opportunity a lot of these countries hold. There are some opportunities we're seeing starting to pop up a little bit in some of the emerging market economies, but we're going to stay mainly U.S.-centric at the beginning of this year, and we're going to continue to do our research and see if we need to add some of those other positions down the road. As always, if you have any questions about your portfolio, please give the office a call. If you want to do an in-office review, call our office. Let's schedule a review. If you want to do a phone review, that is also excellent. By the way, we appreciate your business and your trust. And as always, we had a record year last year of referrals from existing clients. If you have friends or family members who are realizing the firm that they entrust their money to didn't do a great job, isn't a family fiduciary money manager, and they're looking for somebody, we greatly appreciate all your business and your referrals. Keep us in mind. Make sure you have yourself a safe and profitable day.